think it's recording. Okay, so as I said, today it's I was actually thinking of presenting SOAP because I've finished my vol surface, and since the volatility surface has been a recurrent topic over the last few sessions, but maybe I'll talk about it later in the session, or maybe I'll have a dedicated session about it next week or next session. So today I'm going to touch on something pretty controversial. I know that in the world of so-called experts or mentors, I am the ugly duckling because I don't believe in backtesting. I don't know, it's conventional wisdom, maybe, but I'm going to cover very, very quickly why I don't think it is more than just a learning tool. So the usual disclaimer, you know, this is a topic, and those topics come to my mind as I fancy, depending on my work. And I will definitely come back to volatility surface because I'm very, very happy with my coding. SOAP is doing great. I think I managed to capture interesting dynamics. So there will be a dedicated topic on session on that. But today, as I said, I'm going to be talking about stats. And of course, I don't have time for a full-on course or even just a Stats 101 course. So I'm going just going to glance over what are statistics about and the different families of statistics. So essentially, there are two types of stats used by researchers, practitioners in all fields, and they are either inferential or Bayesian. Bayesian is more powerful, but it's a little bit more complicated, even though the formula that I've put on the right here looks simple, but when you dig a little bit deeper, and this means that probability of A knowing B is equal to probability of B being true knowing A times probability of A or event A being true divided by probability of B being true. So it looks simple. So it's when you get into Bayesian statistics, you feel like, okay, I mean, why all the fuss? But when you dig deeper, you can see that it's quite complicated. And again, it's like backtesting in the world of options trading. In 99% of fields of research, people use inferential statistics. Inferential means that you believe something is true. You believe that your data series, your sample, does capture something, and you are going to try and prove it as correct. But as we will see, even though this is the lingua franca and it is used everywhere, it is not as solid as it looks. I read a lot of research papers, master's level and sometimes PhD levels, and of course in these fields of options trading. But when you read any other fields, be it in medical research or anything, even quantum physics, you see that people use inferential statistics, and this is maybe because they need to be approved by peers. So it's kind of, again, of a language that people accept and they validate papers. But exactly like we are in the world of options trading, people tend to ignore the flaws, the weakness of that technique. So what do we do when we do inferential statistics? We try and compare something that we believe emerges from your data sample, and you compare it what we call the null hypothesis. So basically, you try and compare something that is supposed to have an effect with a random variable that has no effect. It's almost like testing some medication against a placebo. I mean, it's exactly that. And of course, inferential statistics are also quite dependent on sample size. The larger the sample is, the more accurate, or the more chances that it will capture all kinds of events. But at the same time, it can also submerge or bury the effect you are trying to push out. So that's actually, so there are two schools of thoughts. Some people believe that you shouldn't have too much of a sample, too large a sample size. But at the same time, if your sample size is too small, there's a chance that you don't capture anything at all. So there's no right or wrong here. That's a little bit complicated. So what is the null hypothesis? So basically, you try and form a sample of data that has no statistical significance at all. So it can be a random variable in like a bell-shaped Gaussian curve, and hopefully, I mean, and to keep things simple, the null hypothesis should try and, because again, we come back to the issue of a sample size. If you try and have too many variables, you will need a larger sample size to be able to distinguish the effect you're trying to bring about in your sample. But generally, it's actually a better idea to try and assess the truth or the correctness in a single variable. You're trying to prove something and just one thing. The problem is that, I mean, in the world of trading, I used to be a directional trader. And of course, it is then fairly easy to compare the efficacy or the validity of some pattern matching, pattern capturing you're trying to do using all sorts of indicators, and they can be simple or complex. And then you try and compare, for example, with a simple buy and hold, or the normal distribution of daily returns or weekly returns or whatever the time frame you're using. In our case, I mean, specifically mine, but I think a lot of us share the same type of approach to trading options. What can the null hypothesis be in a market neutral exercise? This is something that people don't really look into, and they just put anything like the whatever returns. But I mean, this is not exactly what you're trying to do. You're trying to assess whether the performance of your strategy is more than just luck. But then you must have an equivalent sample of data with no bias whatsoever, and that's a difficulty. So again, there are things that can apply, and I'm not even saying now that the inferential statistics are biased or wrong, but even if you are in agreement with that technique, what are you going to compare your strategy against? That's a problem, because what is the typical market neutral distribution apart from doing nothing? Of course, this is market neutral. If I say flat, I do nothing, but I mean, this is not something you can use in statistics. So that's a difficulty here. And then when you have that null hypothesis to compare with, you need to also define what your research hypothesis is. So it can be the quality of an entry, but then what about adjustments later on? Adjustments are often additional degrees of freedom. So the best, if you want to use that kind of inferential statistics, is to keep your problem simple. That's also something that most researchers or practitioners tend to ignore. I mean, to just use inferential statistics. I mean, you get so many formulas in Excel that, okay, you just plug in numbers and you hope you will get something out of it. The real problem is you have to do your work properly. your homework properly. I mean, what is the research hypothesis you're trying to prove? That's an issue. In order to measure how your strategy is different from the null hypothesis, we use a calculation called the p-value. So I'm going to come back to that right now. Oh yes, about sample size. That's also something that I think it's important to bring about, is that sample size generally, and there again, it's maybe conventional thinking amongst statisticians, that in order to represent a world of events, so a population of events, you need to have a sample size of about 30, and that's per degree of freedom. So if you add degrees of freedom, you should have actually more samples, and don't forget, it's going to make your research hypothesis more difficult to define. And there's a well-known theorem in stats called the central limit theorem, that if you use the distribution, I mean, if you design multiple series, multiple samples, the distribution, the mean of the mean of the means, basically, or the overall distribution of distributions will start looking like a Gaussian curve, basically a bell-shaped curve. But that being said, there are a number of research papers that show that the financial returns distributions are, and as we all know that basically, they're in exceptions because of fat tails. We've got black swans on one side and white swans on the other side. And if you are a market neutral trader, both fat tails are actually both black swans, even though you're probably more likely to lose more on the downside. But so we have to deal with that. And again, I'm just piling reasons why it doesn't work. But I mean, I don't want to deter anyone from using them. But I mean, there are a number of reasons for not using inferential statistics at all. So in terms of sample size, there are two types of calculations. And again, I'm not going to go deep, but there's something we call the Z-score, where 30 samples per degree of freedom is supposed to be sufficient. And there's a simpler test called the t-test, which is an acceptable substitute for smaller sample sizes. So let's assume you have a monthly strategy. And let's assume it's a no-touch strategy. And there are not that many no-touch monthly strategies. That would mean that you need 30 samples. So you need at least almost like 3 years to try and, bring about something in your strategy. One can say that in the last 3 years, we've seen a number of different environments, from very low IV to average or above average IV. So we haven't really seen everything. Volatility, the VIX and the skews are now probably more back to normal, but we haven't seen everything in the last 30 months. So that may not even be enough. And again, that supposes that you are not adjusting your strategy at all. So that may be more applicable for weekly strategies, because you can have larger sample sizes, and there are indeed a number of weekly strategies which require no adjustment at all. So that can work. It does not make your work any easier, because you still have to define your null hypothesis very carefully. And but I would say that for weekly trading, I would be more inclined to trust this type of approach. yeah. If you have any questions, you can interrupt me any time. Eh? So can we use returns to be the single degree of freedom? Not really. The returns form the distributions as such, but we need to actually extract what is the explanation factor, what causes your strategy to make or lose money. So so you may have to try and figure out another type of analysis where, for example, you try and gauge how you move the risk around. You know, when you have a strategy and you apply an adjustment, you can see your T plus 0, T plus N, or even at expiration changes. Basically, you're shifting some risk from one area to another. Options trading is typically a zero-sum game. So we not supposed, according to Black and Scholes, to make any money. So the only edge that we have, besides the fact that IV is generally historically higher than historical volatility. So there is overall some premium to be made, but it doesn't give us the recipe. But so there is an edge, definitely. But we need to figure out exactly what we do and how we actually move the risk around. That's actually the difficult part. So I was talking about earlier about the Z-score. So if we look, and if we assume a normal distribution, we all know, because we all use projections. You know, you've got the volatility cone where you can actually figure out the 1 SD or 2 SD move at certain in a projection ahead. And there again, I'm actually now ignoring or minimalizing the effect of fat tails. But if we try and compare your research hypothesis to a null hypothesis, the null hypothesis is generally this type of bell-shaped curve, and we try and figure out your Z-score by looking at this is where you're going to be looking for that edge, so to say. I saw a question, maybe. Ergodicity, yeah, that's actually interesting. Yeah, I'm not going to get into that, but it's actually an interesting topic to study. Yeah, again, I'm just really glancing through and just saying how difficult it is to do your stats properly. So your Z-score is basically, and here I'm presenting a two-tail example, and it can be, of course, a single tail if you're only looking at, for example, the quality of a hedge or something. So you calculate your Z-score by the value minus the mean divided by the sigma, by the standard deviation. And that's exactly your p-value. So you're trying to figure out whether your p-value is, and generally people accept a p-value of below 5% to reject the null hypothesis. And sometimes if you want to be more precise, more accurate, and some people look for a more difficult objective, that is the 1% p-value. But that said, if you will need a much larger sample size to reach such objectives. So we have the same problem. The quality of your data, the quality of the length of your back testing, how far back you go. Not even mentioning that the dynamics of the markets do evolve over time. So your sample is not stationary. I mean, there are lots of things that may change during the course of your study. And that's why a number of researchers or quants would rather do, if they go for inferential statistics, they would rather go for a sample size so that is actually shifted back in time, and then they leave a test sample that is closer to now. So for example, if you have, let's say 30 months, 3 years, let's go for 3 years, you would go, for example, 2016 to 2018, and you would then test are accurate or whether your stats are still valid for 2019. That would be the typical test. Yeah. Some go even further as placing a third set of data. So they've got the sample, then the testing sample, and then what they call the production sample. So this, which is more the live data, which is not exactly live because it is not, the strategy is not in operation as such, but they try and see whether the statistics, even the statistics calculated on your test sample, as I mentioned now, 2019, they can still be biased. So they add a third period of time, which would be the production time or the live data or quasi-live data. So what are alternatives? Because of the difficulties in having a large enough sample, and because also the time series that you get is just one path, one course of events along the time axis, and there can be many, many more. I mean, like Brexit could have happened earlier, or this strike against Iran or back, or events are pretty much random. So the best way to actually do a proper backtesting, and again, assuming that you stick to inferential statistics, is that you generate your own time series. You can you generate pseudo stock market data using what you call a Wiener process, or which is something equivalent to the geometric Brownian motion that is the basis, the very basis of Black-Scholes. And basically you design, you draw hundreds of different paths based on the same type of parameters. And of course, there are parameters, like markets tend to move up as time goes by. So there's, of course, a drift that is generally positive. And there's also of course, an average standard deviation, an average movement that is very much linked to the symbol you're trying to analyze. So you can use then a Monte Carlo analysis. So basically you generate hundreds or thousands of different distributions, and you look at how your strategy behaves in all of them. And generally in Monte Carlo analysis, you try and discard, or you do your value at risk, basically. So you try and look whether there are, in those hundreds of scenarios, some scenarios where you can lose your shirt, or whether you're going to make a lot of money. So the general usage of Monte Carlo is basically to try and see whether there's a risk of ruin. I mean, that's of course the most important thing. Before you look at making money, you first want to make sure that you're not going to lose it. So Monte Carlo also has a few drawbacks, but it is a powerful technique. Another way of looking at a historical study is to use genetic algorithms. So you also generate a population of path, historical path, and you see, I mean, the genetic algorithms generally are, tend to converge towards a fitness function. So they tend to converge towards an objective. So then there you can see, I mean, it's more versatile, but it's maybe sometimes a little bit more complex, but it helps you figure out what is the, for example, the highest likelihood of a path going through being realistic. I am not going to touch on Bayesian statistics because it's actually quite complicated, even though the formula I showed above looked pretty simple. But this is a very interesting topic, which I'm studying at the moment. And I may come back to that at some point. And it looks like it does not share a lot of the weaknesses that we've seen in inferential statistics. Oops, what's going on? No, yeah. Last year, there was a paper in the Nature magazine, the Nature review, which of course will take time to sink in all the different fields of research, mostly because people are not yet prepared to move on to Bayesian statistics. The thing is that it's a paper that has been co-written by, I believe, 800 top statisticians around the world. And they came with the conclusion that, and again, I'm assuming that everything I said before is valid or valid enough, so that you can design your null hypothesis, you know your research hypothesis, you can calculate, you've got your right distribution, etc., etc. They reckon that the p-value is basically a lot of nonsense. So this is really that's why I call it the coup de grace. It's French, but it's also used in English. So basically, we don't know on what leg to stand on, because this is the real problem. P-value, and we all know that, you know, correlation is no causality. I mean, all those things we know, but the problem is that the p-value may not reflect the quality, or we may not reflect how valid your hypothesis is. So this is really a problem. This is a big problem that I mean, it came about last year. And as I said, it may take a few years. And what I'm seeing, because I'm trying to read a few reviews from statisticians, I see that there's a slow move towards Bayesian statistics, but a lot of people are not equipped, not skilled, they haven't learned it. So I can only invite you to look into that. But of course, first explore everything I've said. I mean, you don't have to take what I'm saying now as a new gospel, but I'm just saying that it's a shaky type of ground we're working on. And I'm not even saying that a lot of people actually doing backtesting don't even look at all about inferential statistics. They don't care. They believe that by using just one historical path, just testing and ignoring degrees of freedom, they don't even test whether their strategy has an edge by way of p-value. Quants do that. Professional traders do that. But retail traders, they use whatever the platform is giving them, and they don't care. So if you do Monte Carlo, I mean, if you do your homework properly, I am not going to throw the baby with the bathwater. But it's difficult. And if I just name one problem, I mean, what will be your null hypothesis if you're a market neutral trader? And this is as simple as that. So basically, people just look at the performance, and I've seen so many traders doing back testing and spending less than 2 seconds on each example, each step. You know, they scan day by day or hour by hour. They ignore anything that is not on their screen. What was the IV environment? The skew. They look at the risk graph. Okay, looks good. Next. I mean, this is the problem. People don't really think. They just look at, okay, I didn't have to adjust. Oh, okay, I have to adjust. They want to rehash rules that they've learned, and they believe that it's going to be good enough. And that is ignoring a lot of factors that could make their analysis absolutely wrong. So yes, backtesting is a good confidence boosting tool. There's no better way to learn a strategy than just run through the last 3, 4, 5 years and see, okay, I understand what was in the mentor's head or in the strategy designer's head when he came up with that strategy. Yeah, I understand but it's very empirical, and there's no way of measuring how valid it is. Let's not forget it, because I actually coach on the Rhino, and I always say, well, you've got to make the Rhino your own. I mean, this is not a strictly rule-based strategy. Of course, many people tell me, no, keep it simple, keep it simple, keep it simple. Make your rules simpler. But I can't do something I don't believe in. I look at a number of things that beginners don't even have a look at. When I do, I always recommend and suggest, I encourage people to make the Rhino strategy, and it could be the RTT, it could be a blend of strategies, to make it their own. And I'm happy that some people who have actually learned with me or from me on our trading hybrid strategies that are more, they are a lot more comfortable with, and that's exactly what I want. But of course, if I said, well, I'm going to teach you a generic broken butterfly strategy, it's going to look awesome and complicated. So of course, being a mentor or a coach is also a business. You've got to do marketing, and you've got to tell what people want to hear, and what they want to hear is going to be simple, and you're going to make a lot of money. Forget about the stats, forget about, I mean, this is all too complicated for me, like as it is for you. I mean, this is something I'm not comfortable. I'm not very comfortable with talking nonsense. But there again, I do understand that when you take a strategy and you make it your own, it's a gradual transition. And of course, the best way to get into the designer's head is to backtest his ideas. So of course, you're going to look at the past and you're going to run it through, and you will see. But sometimes actually there are adjustments that you think, wow, he did that, and I don't think I would have had the guts to do it. That sometimes you realize very early that the strategy is not exactly yours, but sometimes you just look at the stated profit and you say, well, it's okay, I'm gonna stick to it. So again, there are lots of flawed stats. There are no real scientific evidence. The whole grounds, the whole foundations of inferential statistics have been shaken deeply. So I'm just saying that if you do backtesting, try and do it properly. Use large samples. Try and keep your degrees of freedom as small as possible. I would say that weekly trading and preferably no touch type of strategies may be more applicable. And write down, when you do your backtest, look further than what's on your screen. Maybe have a look at the VIX Central. What was the horizontal skew, the vertical skew? Sometimes you apply a rule, but that was designed in another for another environment. I mean, I'm pretty much experienced, but I also made mistakes because I had never seen in 2017, early 2018, such a volatility crash when the VIX was below 9. I mean, that was crazy. And there again, I mean, you could have gone with a sample size of 20 years, you would have not seen it at all. So I'm not saying that you can't do it, but you just have to be very careful. You just have to be very careful. So, and that's my motto. What should be done? I believe you have to look, have a wider spectrum of things into, or more tools at your disposal. A lot of people get really sucked into watch and look at what the screens offer, like, risk graph. They don't really, for example, when there's an adjustment to be done, people don't really see that you are shifting risk from an area to another. It's good enough in most cases to trade by the Greeks, because of course it will be reflected in the Greeks. But sometimes, you know, it's quite important to look at how you shift risk and what is the volatility environment. Most of us are short Vega traders. We sell premium. So you must look where your Vega risk is. So all I'm saying is that if you want to stick to historical backtesting like it's done in option view or one, try and spend more time on each step. Try and see what the market was doing and what was the main drivers for a move. And sometimes technical analysis can help. Sometimes when you do your backtesting, try and go back to the calendar. Were there earnings? What were the news? I mean, all those things people don't look. I mean, as I said, I'm shocked sometimes to see people spending less than 10 seconds on individual step. When people were complaining that option view was too slow, or the back trader was too slow, I kept on saying, well, this is a good thing. Spend more time. Don't be, you know, clicking away, next step, be it an hour a day. You have to spend time to realize what was going on. The data sampling may be incorrect, but that's another issue. I mean, we all live in an imperfect world, but at least spend time. I also recommend for those who are who can code programs, because this is not available in retail platforms, is to use generated time series. Try and use, I mentioned the Vina process. I mean, try and generate many, I would say it's other universes, you know. I won't get into multiverses, but, you know, try and generate multiple pasts and to see how your rules would have behaved in different environments. Of course, if you use a generated time series, you are going to lose out on what's around it. You will not be able to look at earnings, news, and IV environments. That's going to be more difficult, but at least you will have a more valid statistical analysis. Right, I think that's about it. 40 minutes. I usually want to do my topic over 30 minutes. So now if you have any questions. Oh, there's one. Interesting that the big money with all the potential investing in great research always look to someone to screw price manipulation. Oh, yeah, well, that's not a, that's a off topic. I believe the market is sufficiently efficient. Of course, when you look at book trading, I mean, when you trade stocks and you look at the books and you know who does what, you can see that there is some manipulation, but it's mostly short-term type of manipulation. I think over the long term. So if you were a day trader, I would say yes. Over the longer term, it kind of irons out those anomalies. Right. Any other question? I mean, are any of you actually fans or strong supporters of general backtesting? Oh, generating your own time series. Well, you can use I mean, you can generate time series by using a Vina process. So basically, I can actually share a spreadsheet that does generate time series based on a geometric Brownian motion, which is, if it's not 100% correct, let's not forget that's what Black & Scholes has been using since day one as a basis for pricing options. So you do you do generate time series by generating, but there's a random factor in a geometric Brownian motion because it's basically a statistical variable or random variable that's in it. So there's a drift, and then the drift is basically the long-term trend, and there is let's say a random variable that makes your time series zigzag up and down. So it's actually not very difficult. Then what you do is that you assume, I mean, the best is, of course, to have a time series that is not too far from the reality so that you can use, for example, historical interest rates. And then you can eliminate the effect of the dividend yields. So that's not that dividends are not an issue. And what I'm saying is that when you have all the parameters, you can actually do theoretical pricing of your option or option chain. So it's, as I said, it's not easy. It's not easy. So I'm not saying that you should embark into that. It's complicated. And it's of course easier if you were just a day trader or trading directionally, because then there's nothing else to add. Of course, in the options world, you have the rates, the dividends, and the volatility environment. So it's not because you generate just a pseudo path for SPX or the Russell, then you can then work out the option chain and how you can then backtest repetitively your strategies on mock history. So it's actually a little bit complicated, but this is something that is done regularly for directional futures traders. A lot of directional futures traders do that. So what I could say is that there are reasons why nobody does it with options, because it's very, very complicated. So now you have to figure out where to stand between using a backtesting technique provided by a platform that is large. Sorry, I lost my connection. Are you still there? Okay, sorry. I don't know exactly where I was. This is this is the problem when you live on a tropical island. Okay, good. So I don't know exactly where I was, but all I wanted to say is that it's a difficult position, you know, between just dumping stats. I mean, you can't trust them, so let's not do it at all. And do it properly, which can be very, very complicated. I've done that in the past when I was a quant, but I was then trading futures, I was trading directionally. So I was limiting the number of issues I would come across. So at least you know that now that and all I can say, just not to sound too negative, is that at least try and do your back testing with a pinch of salt. You know, it has no statistical evidence, but at least if you want to do it properly, try and keep your degrees of freedom small. Try and avoid adjusting too much, and preferably use a larger sample. So maybe on weekly trading. So I can't end this discussion with something more conclusive. It's a very difficult topic. And maybe I will confuse you even more, because now you do your backtesting thinking, well, it has worked well over the last 3 years, so I can confidently start trading real money. Still, I would say be careful. Be very, very careful. Okay, I think my connection is too bad. So, and if you have no more questions, I'm going to leave it there, and we can carry on discussing on the forum. You know that you can contact me on bruno@aeromere.com. I mean, and this video will be posted on my YouTube channel. So there are many ways to get hold of me for further details. So next time I'm going to be back to Vault Surface because I'm very, very proud with my stuff. My Vault Surface is cool. Yeah. So yeah, I mean, I will show you next time. Okay, thanks for being there. And if you have any questions, more questions maybe. Okay, no, thanks for being there. I mean, I know I'm not a very popular guy, but you know, I can't shut my mouth. That's who I am. Okay, happy New Year to you all, and I'll be back in 2 weeks' time with more on the Vault Surface. Bye for now.